Let's bring in Mohamed El-Erian, Allianz Chief Economic Advisor. Mohamed, great to see you. Thanks for joining us. Before we get into the questions, I should also mention, by the way, that the S&P 500 didn't quite finish at an all-time closing high after things settled moments after the close, just a point or so below, contrary to what we were saying moments earlier. Mohamed, good to see you. Of those risks to the market, are you in agreement with the order of them? Which is your biggest threat to equity market levels at the moment?
So my biggest threat would be some combination of higher yield and a market accident. It is really impressive how well the stock market has done in the first quarter, given higher yield, all sorts of rotations within the market between stocks and bonds, 3 near accidents, what's been happening in Europe. So this is a very resilient market, but I would keep an eye on yields and pockets of excessive risk-taking.
Mohamed, I wanted to ask you about the Archegos issues that we've seen over the last week or so. And I wondered whether you thought there was risks of other overly leveraged long positions in the market, which might be kind of flattering the levels that we've seen. And not necessarily that there are more blow-ups to come, but just to highlight how stretched things could be perhaps to the upside.
There could be. You know, I came on Monday morning and said, while this is a typical case of massive leverage, over-concentration, derivative overlays, it will be contained. However, there's a bigger message coming out. So in terms of, are you worried about the stock market today? The answer is no. But the underlying forces are to lever. Leverage is so cheap and so abundant that, yes, there probably are other pockets of excessive risk-taking. And the question becomes, do they explode at the same time? So far, we've been able to handle these 3 near accidents, which is a good thing.
So it sounds like you're not too worried about it overall. It could happen, but I mean, the Fed's not taking away the punch bowl anytime soon.
The Fed is not going to take the punch bowl anytime soon, I agree, Sarah, but banks may start being a little bit more cautious about the sorts of credit line they've been extending. There's a lot of embarrassment right now in certain banks. How could we have allowed this family office to do what it did? And how could we have been the last one out and not even getting out, just sitting on massive billions of dollars of losses? So I suspect there's a lot of banks looking very carefully right now at what else have they extended in terms of margin loans. So what may happen is not the Fed takes away the punch bowl, is that the system itself becomes somewhat more disciplined.
Shepard Smith here. Thanks for watching CNBC on YouTube.